If you're trying to figure out what the heck is going on out there with inflation, I don't blame you for being a little bit confused. There's so much conflicting data out there, both here in Canada and around the globe. And I was looking at a few reports this morning and things seem to be all over the map. In this video, I'm going to try and make a little bit of sense of what's going on out there. And I want to start with the latest Bank of Canada's Business Outlook Survey for Q2 2024. And this report shows a downbeat outlook amongst businesses and consumers, which then raises, of course, the likelihood of a second interest rate cut, which would be scheduled for next week, July 24th. This survey shows that individual expectations for near-term inflation have declined significantly. Then you take this and you couple that with a somewhat unenthusiastic business expectations for future sales, for minimum interest in hiring or investing. That's suggesting a pretty gloomy economic forecast. In the report, the Bank of Canada noted businesses expect the growth of their input prices and selling prices to slow, suggesting that inflation will continue to decline over the coming year. So here we're saying the expectations in Canada are that the inflation rate is going to continue to decline. This aligns with most of the company's beliefs that inflation is going to stay within the bank's 1% to 3% control range, at least in the next few years. Experts believe that the negative business and consumer sentiment will actually have an influence on the bank's upcoming decision. TD Bank rate strategists Robert Both and Andrew Calvin, they said, "We believe the more downbeat tone from business and consumer sentiment will allow the Bank of Canada to look through the upside surprise on the May CPI report." As of this morning, interest rate swap traders, they're now betting on another rate cut. The financial markets are pricing in an 80% chance of a quarter-point reduction when the bank reports next week. So this business survey, it shows a pretty grim corporate mood out there, and it shows many firms are expecting weak sales, minimal interest in new investments, or in hiring. According to the Bank of Canada, weak demand, elevated interest rates, uncertainty about the business environment, and the high cost of machinery and equipment were cited as discouraging investment. Now, on a slightly positive note, there are fewer firms that are facing supply chain issues. The number of companies that are reporting labor shortages has also decreased. That said, consumer sentiment, it remains strained. Most individuals are reporting that they're cutting back on spending and feeling a little bit pessimistic about the economy's future. So Canada's latest inflation numbers are out, and they fell more than expected in June. And this increases the likelihood that the Bank of Canada will cut interest rates, as I mentioned earlier, beginning next week. The Consumer Price Index rose by 2.7% annually in June. That's down from 2.9% in May. And analysts had expected a slight drop, but to 2.8, not the 2.7 that we saw. On a month-to-month basis, consumer prices fell by 0.1%. That marks the first decline in 6 months. So despite this strong CPI report in May, inflation generally has been pretty weak this year, and it has stayed within the central bank's target rate, that 1% to 3%, for 6 consecutive months now. So when you look at the progress we've seen here, the Bank of Canada reduced its benchmark lending rate in early June to 4.75 from 5%. As I mentioned earlier, that's the first cut in 4 years. However, the bank's approach is, of course, data dependent. The timing of future cuts remains uncertain. We've seen a rise in the unemployment rate, which reached 6.4% recently. That's up from the historic low of 4.8% 2 years ago. Households, they're also cutting back on discretionary spending. On the rate cut topic, though, economists, investors, they're now feeling more confident about another rate cut. An example, Royce Mendex, he's the head of macro strategy at Desjardins Securities, and he says a return to tepid consumer price growth likely seals the deal. He noted that this latest data out will continue to support a rate cutting cycle now that will start without delay. Some of the notable CPI numbers that were out in this report: grocery prices increased for the second consecutive month. They grew at an annual rate of 2.1% in June. Shelter costs rose by 6.2%. Then on the downside, we saw gas prices falling by 3.1%. Travel tour prices dropped by 11.1%. Prices for durable goods fell by 1.8%. Furniture prices were down 3.9%. Toronto Dominion Bank senior economist James Orlando, he says recent data have supported a cut, with the job market loosening, the wage gains decelerating from elevated levels. And he emphasized that the Bank of Canada is likely to continue cutting rates steadily over the next year. Looking for a smart way to invest your money? Well, BMO ETFs and mutual funds, they offer you a range of solutions to suit your needs and your goals. Whether you want to diversify your portfolio or access innovative strategies, BMO GAM has you covered. You can choose from a variety of ETFs, mutual funds that span across the markets, asset classes, and geographies. And you can also benefit from BMO GAM's experience and insights on the latest trends and opportunities in the financial world. BMO ETFs and mutual funds, the right fit for your portfolio. Visit bmogam.com today to find out more. Also providing support for today's episode is Qtrade Direct Investing. They are the winner of the top spot for the best online brokerage experience for Canadian investors. So if you're looking for a brokerage account, you can explore their suite of offerings. This includes over 100 commission-free ETFs, real-time quotes, advanced portfolio analytics, stock screening tools, analyst reports, and more. And with over 20 years of experience, Qtrade is trusted by self-directed investors. They have instant account opening. Their platform makes it easy to open and manage your accounts from anywhere. Plus, you can get $50 when you open and fund a new account, up to $150 for 3 account. Join Qtrade now. Link in the description box below. Now, staying on the inflation topic, because that's what we're talking about today, the International Monetary Fund, they've issued a warning that global inflation, in contrast to what we're hearing here in Canada, might remain high and it might keep interest rates elevated for longer than previously anticipated. They're saying that the situation we're faced with now has been driven by persistently high prices for services. They cite haircuts, hotels, restaurants, as well as escalating trade tensions. These could lead to increased financial risks on a global scale. This caution comes from the IMF's latest World Economic Outlook, and they highlight that central banks may delay cutting interest rates due to these persistent inflationary pressures that we're seeing. Federal Reserve Chair Jerome Powell, he stated recently in the U.S. that the central bank official needs greater confidence that inflation is moving sustainably towards the 2% target before he will consider an interest rate cut in the U.S. And similarly, the Bank of England, they recently held off cutting their interest rates despite the fact that UK inflation is now down at that 2% target. They cite higher than expected services inflation there. In the report, they underscore that monetary policy needs to be restrictive for an extended period of time until the risk of inflation becoming embedded above the 2% target dissipates. The IMF forecasts that global inflation will decrease to 5.9% this year, down from 6.7% last year. However, it blames slow progress on sticky services price inflation driven partly by higher wages. Now, Pierre-Olivier Guerencha, he's the IMF's chief economist, and he noted energy and food price inflation are now almost back to pre-pandemic levels in many countries, while overall inflation is not. He added that rising services prices and wages may keep overall inflation higher than desired, posing a significant risk to economic growth. Trade tensions, particularly recent hikes in tariffs by both the US and the European Union on Chinese products, those are also contributing, obviously, to inflation. And these actions, they increase the cost of imported goods, and that could further elevate near-term inflation risks. Guerencha, he expressed concerns about the unilateral measures, and he says, if anything, it will distort trade and resource allocation, spur retaliation, weaken growth, diminish living standards, and make it harder to coordinate policies that address global challenges, such as the climate transition. The IMF projects the global economy will grow by 3.2% this year, and that maintains its April forecast. However, it has slightly downgraded its forecast for the U.S. growth to 2.6%. The Eurozone's growth, that's expected to be a relatively modest 0.9%. There were upward revisions made for India and China, with projected growth rates there of 7% in India and 5% in China, and that will account for half of the global economic expansion. And as Guerencha noted, Asia's emerging economies remain the main engine for the global economy. Former U.S. President Donald Trump, who is now the 2024 Republican presidential nominee officially, he could have a significant impact on global inflation if he wins a second term, according to some analysts. They're concerned that his America First policies, which include high tariffs, they include tax cuts, could drive up costs on a global basis. They say that this economic agenda might have an even more substantial effect this time around than the first time that he was the president. Now, Michael Metcalf from State Street Global Markets, he pointed out that the inflationary impact of Trump's policies could be more pronounced in a second term. And he says there's a bigger risk that Trump's policies will be more inflationary in a second term than they would have been in the first. And he goes on to explain that the current economic climate is different from 2016 with higher inflation levels now, expectations already set. So any of these new policies could just amplify the impact of inflation. Also, high tariffs, they typically lead to higher prices for imported goods, which of course allows domestic producers then to increase their prices. And when you see this shift, it results in higher prices for consumers pretty much across the board. He talks about tax cuts. On the other hand, they could lead to increased consumer spending. That's kind of the goal you want it to do, but that also could drive up the prices of goods and services. Both Trump and President Joe Biden have indicated that they would raise tariffs on China if elected, and that reflects the ongoing geopolitical tensions between the two countries. Analysts from various financial institutions, they've shared their insights on the potential global indications. I want to have a quick look at a couple of those now. Gareth Nicholson, he's from Nomura. He noted that a Trump presidency could be a negative risk factor for Asian stocks, potentially causing inflation supply chain shifts. In Europe, Goldman Sachs has predicted that a Trump presidency could add 0.1 percentage points to inflation, again, due to the higher impact of tariffs on global trade. And Manulife's Mark Franklin, he agrees with that. And he says that Trump's policies could create what he's calling a somewhat reflationary mix of rising inflation expectations and higher interest rates. So here we are. If Trump's, not if, it's really sort of as Trump's campaign seems to be gaining momentum, especially after the recent assassination attempt that he survived, analysts are cautioning that the initial positive reaction from investors may be short-lived. Concerns over his protectionist agenda, potential impact on global inflation definitely remain significant. If you aren't subscribed yet to our Pulse newsletter, that comes out every weekend. I'll make it very easy. I'll add a link in the description of this video. I'd like to thank you very much for watching this video, and as always, we'll see you in the next video.